But really, let's add context into why it's about to explode. We need to look first at the desperation moves in the ETFs flywheels and how this is offering up opportunities for physical stackers in both silver and gold.
Andrew, can you take a couple of minutes here and talk to our silver stackers? There's a lot. We're accumulating a lot of community members that are really interested in silver these days.
Yes, you bet, Shane. It's silver. Of course. I was waiting for that question. What we need to do is to add context into why the silver price has been lagging. And this is the big question. It's everywhere. But it's been lagging. But really, let's add context into why it's about to explode. We need to look first at the desperation moves in the ETFs flywheels and how this is offering up opportunities for physical stackers in both silver and gold. I mean, it's almost too good to be true. Silver is really interesting here. While physical gold demand is very strong into tight, constrained refiner supply, silver production from European refineries has ground to a complete halt. With production capacity severely constrained, silver is being refined. Silver is not being refined because in favor of, obviously, you've got limited resources. You're going to produce. It's more profitable to produce gold, not silver. So silver shortages will accelerate, which is why silver began leading the rally higher. And furthermore, we now have Russian refineries now ramping up wholesale premiums to previously unseen levels. Well, go figure, because you recognize the fact you can get the supply is tight, you're going to up your premiums. And with silver refining grinding to a halt in Switzerland and Europe for the first time since March 2020, that's got our attention. This was when refineries completely shut down. But silver refining has once again come to a halt. Now, okay, it's a different circumstance, but it's come to a halt in Europe. So it's relying now on Eastern European and Russian refiners for supply, hence the ramp up in global premiums. And I don't think this is going to go away. And while this Omicron-related worker shortage will ultimately be resolved, in the interim, it's causing technicals to be bullishly reset. And as the multi-year paper-centric bearish trend lines are one by one invalidated, it will in turn incentivize sideline money to enter silver, which is waiting primarily at the cross of about 26 or again at 30 and so on and so forth. But there are definitely sideline money waiting to come into silver once it breaks these trend lines. So, we have a condition here which has been responsible for the self-fulfilling placement of the bearish OPEX bets that have contained silver for so long are really so far below supply-demand fundamentals. And really, when these bets were placed, the factors were completely separate. So very short term, very, very short term, we anticipate some COT bid pulling. I mean, we talked about this. The commercials are not short selling gold and silver. They're conducting bid pulling exercises and buying the dips. And what they're doing is by bid pulling, you can force some spec-driven profit taking in gold futures and silver futures. And what they're trying to do is rescue some deeply underwater options bets expiring on Wednesday the 26th, which is tomorrow, and more importantly for gold, the related BIS OPEX next Monday. But when these bets were placed, this is the point, the physical supply and geopolitical inputs were just not a factor. Many of these bets were placed up to 12 months ago, not factoring in the tight physical supply conditions resulting from the refiner production warnings that we reported 2 weeks ago on the 10th of January. So the option structures, which is the other question we get, what are they? As we enter COMEX OPEX tomorrow, which will be in the rearview mirror once this webinar comes out, on this episode comes out. But the BIS OPEX next Monday, really, we're seeing these structures completely roiled due to the factors we're just talking about. And obviously, with COMEX OPEX tomorrow, the Fed, of course, on Wednesday. We may see some fireworks over the next 3 sessions. Well, I would expect to do so. And indeed, Fed uncertainty may provide the perfect cover to initiate some tactical bid-pulling efforts. But as the Omicron fallout is now risking the baked-in Fed rate hike pivot as well, we may see a reversal of these hawkish expectations, which are baked in. Either way, those rate hikes expectations are baked into gold and silver prices. And what that's doing is risking an upside price revaluation. So if we look at last night's options levels, now it's going to be pretty close to what we see tonight and how we go into options tomorrow. There's some large calls threatening to close in the money above 24 and 25 in silver, and some very wrong-footed bets at 1850 looking to be under threat. Now, there's no doubt that when these bets were made, that the refiner production constraints, they just weren't factored in. Now, drilling down a little in gold futures, there's an extremely strong option support between 1800 to 1810. Now, very, very strong. So I don't think it's going to come anywhere close to being tested. But the option sweet spot is still technically between 1805 and 1830, which explains some of the action leading into options. And there is a maxed out options call structure, which is usually what is defended at 1850, which is what, as I say, that's being defended right now. But given that the NSFR constraints, once this is exceeded, delta hedge futures buying will ignite a rally very quickly into the 1900s. And that's pretty darn certain looking structurally at it. And in silver futures, because that's the other question, where is it? There's a maxed out options support at 22.5. So if it goes below there, it's going to cost far too much physical. And while some 2021 bets against 23 are rapidly being unwound now, the only real very short-term options resistance is right now 24.25. So that may be short-term why we're seeing this incredible defense at 24.25. So which like gold futures will hold very large short covering potential. Now, it has to also be borne in mind that European refiner delays will tighten up the very active kilo bar market, driving up premiums for retail, spilling into the wholesale market. So really, refining wholesale bars is less profitable than refining kilo bars. So you might see that see the kilo bar market start to be in favor. And as far as the 10 times larger BIS option sweet spot for Monday is concerned, the upper band, as I say, still 1830. They may use unallocated supply to protect these positions into Monday the 31st, but below 1830, it will deepen backwardations and cost them real physical they cannot deliver on. And there may be an attempt to talk the market down, but dips will be very, very shallow here with such strong physical interest below the market.